Greetings, everybody. Welcome to Liberty Call. Today is Monday, October 30th, 2023. I hope everybody's having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado, a little chillier than when we last left on Friday. It is looks like Hoth outside. There is snow everywhere. We got about a foot. We were supposed to get about 3 inches. Instead, we got a foot of snow. But it's wet and heavy. So actually, I might go out and try to clear a little bit more off the driveway because it's a wet, sticky mess out there. So anyways, hope you had a good weekend out there in the interwebs. And if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, press the subscribe, the like, all the good buttons down at the bottom, the thumbs ups. Press that notification bell because you want to know when I go live. I mean, I might say something smart. Maybe not, but I might. All right, let's go ahead and get into the numbers for today. All right, Dow Jones was up today, 1.58%, 511 points. Woo! It's closed at 32,928. S&P 500 was up 1.16%, closed at 4165. NASDAQ was also up 1.16%, closed at 12,789. The VIX fell 7.01% today. It's down to 1978. Canada was up 0.64. Brazil was down 0.71. And Mexico was up 0.61. Our friends over in Europe, Germany was up 0.2. The UK was up 0.5%. France was up 0.42. The Netherlands down 0.04. Spain up 1.07. Italy up 0.19. Switzerland up 0.57. And Portugal up 0.12. Russian exchange is in the green today. MOEX up 0.09 and the RTSI up 1.42. And our friends over in the Asian markets, starting out with the Nikkei in Japan, it was down 0.98. The Australian markets were up, down 0.79. New Zealand was down, New Zealand was up 0.27. In China, the Shanghai was up 0.12. The Shenzhen component was up 1.61. China 850 up 0.35. DJ Shanghai up 0.43. Hang Seng up 0.06. And the Taiwan weighted was up 0.09. All right, so a lot of green on the screen. We got happy markets out there. I need to get my Bob Ross and happy little stock markets and draw little clouds above it. Anyways, yep. For today, it seems like everyone's in a good mood. We'll see what happens when the Fed meeting starts tomorrow and what the results of that will be. All right, let's get to the weekly economic update. Amid a busy week of corporate earnings reports, stocks slumped on cautious earnings guidance, fears of higher interest rates, and growing anxiety over the increasing amount of Treasury bonds and notes coming to market. The Dow Jones Industrial Average dropped 1.88%. The S&P 500 declined 3.29%. NASDAQ gave up 4.48%, and overseas markets retreated 1.82%. The October slide continues. Stocks continued their slide last week despite mostly better than expected earnings results. While earnings surprises were generally positive, investors were troubled by declines in year-over-year net profit margins and tepid earnings guidance. Particularly hit hard were technology companies following mixed earnings results. Economic data released on Thursday showed remarkable economic strength with above consensus forecast growth in the third quarter gross domestic product and September's durable goods orders, with only a minor uptick in initial jobless claims. The result fanned worries that the Fed might need to hike rates further or at least maintain higher rates for longer. I think it's longer, folks. Strong economic data. The first read of third quarter economic growth was a blowout, with GDP increasing at an annualized rate of 4.9%. This pace was well above the prior quarter's 2.1% expansion and above consensus forecasts. Powering the third quarter's economic performance was strong consumer spending and inventory buildup. Durable goods orders jumped 4.7% in September, confirming the nation's continued good economic health, easily outpacing the 0.1% rise in August and economists' forecast of 2%. Meanwhile, initial jobless claims slightly increased, suggesting the labor market remains healthy. Economic data this week. On Wednesday, we have the FOMC announcement. That's when they finish up their meeting on Wednesday afternoon. The ADP employment report, the ISM manufacturing index, and the job openings and turnover survey. Thursday, we have the factory orders and jobless claims, and Friday, the employment situation and the ISM services index. Companies reporting earnings this week. Today on Monday, we had McDonald's and Arista. Tuesday, we have Pfizer, Caterpillar, Amgen, and Marathon Petroleum. Wednesday is Advanced Micro Devices, AMD, CVS, Qualcomm, PayPal, and Humana. Thursday, Apple, Starbucks, Shopify, Eli Lilly, Duke Energy, Cigna, and ConocoPhillips. And to close out the week, Berkshire Hathaway reports on Friday. All right. So exciting stuff, isn't it, folks? I know I'm excited. I mean, no one's watching right now, but it's very exciting. I can tell because there's like a little counter up here that shows when people are viewing the live stream. All right, let's go ahead and get to today's market recap and see what it has to say. S&P 500 rallies ahead of busy week as Apple earnings and Fed decision are eyed. The S&P 500 experienced a positive boost on Monday, primarily driven by major tech companies, with particular focus on Apple's upcoming earnings report and the Federal Reserve's upcoming interest rate decision. Investors are eagerly awaiting Apple's earnings results, which are due on Thursday, especially regarding iPhone sales in the context of reports indicating slowing demand. Additionally, Apple is anticipated to announce its third-generation Apple Silicon chip, generating further interest in the company. General Motors reached a tentative agreement with the United Auto Workers, ending a 6-week-long strike at Detroit automakers. The agreement shares similarities with recent deals between the UAW and automakers like Ford and Stellantis, including provisions for wage increases and cost of living allowances. While GM saw a marginal increase in its intraday stock price, Ford and Stellantis experienced declines. If I was running these car companies, I'd tell everyone, you're all fired. And we got all these people, all these young folks, they need to learn how some job skills. We'll bring them in. You guys can go figure out something else unless you're too whiny and want too much money. All right, jumping back in here, Treasury yields climbed on Monday with investors eagerly awaiting the Treasury's refunding announcement scheduled for Wednesday, which outlines plans for note and bond sales. The recent rise in yields and a sell-off in treasuries have been partially attributed to the increased supply of treasuries. Jefferies expects a downward revision of borrowing projections for Q4 from $850 billion to $745 billion. All eyes are on the upcoming Federal Reserve interest rate decision with expectations of a potential rate pause. I'm curious myself. McDonald's reported quarterly results that surpassed analysts' expectations on both revenue and earnings, primarily driven by recent price hikes. Can't be because their food tastes good, because it's... As a result, McDonald's stock rose more than 2%. SoFi Technologies also delivered better than expected quarterly results, raising its full year outlook due to stronger than anticipated demand for student loan refinancing, leading to a modest increase in its stock. In the chip industry, ON Semiconductor experienced a more than 15% drop in its stock price, despite better than expected Q3 results. This decline was mainly due to disappointing Q4 guidance, with earnings per share expected to be in the range of $1.13 to $1.27, and revenue projected between $1.95 billion and $2.05 billion, falling short of Wall Street estimates. In contrast, Western Digital saw its stock price rise nearly 8% after reporting fiscal quarterly results that exceeded expectations. The company also announced plans to spin off its flash memory business, turning it into a standalone business in light of the collapse of a merger talks between Kioxia. All right, so everybody seems to be in a better mood today. I mean, I'm not sure why, but I mean, we still have all the same problems we had last week. I mean, they didn't go away just because the market was green today. All right, last up, article from First Trust, Mr. Brian Westbeard, their chief economist. This one is titled, "It's the Same Bear Market." All right. The S&P 500's recent decline, which has taken it more than 10% below its late July peak, has raised concerns of a new bear market for stocks. Some argue that there was a bear market in 2022, followed by a bull market from October of last year through July of this year, and now another bear market since August. However, this view may not be appropriate. It's not a new bear market, but rather a continuation of the previous one. In 2022, a bear market occurred, followed by a temporary rally before the bear market resumed. And actually, we can pause that. We can go to our chart here and we can look at it. Let's make the screen bigger. All right, there we go. So what he's talking about here is this is the beginning of last year, 2022, when the downturn started, and this is the Dow 30, was in a downtrend most of the year, broke the downtrend late last year, traded sideways, had a little bit of an uplift. And, this was, I think, hopes that the Fed was going to lower interest rates. Didn't happen. And then we've started to line up a new downtrend. So same thing with the S&P 500. Didn't break the downtrend until earlier this year, but it's still the same bear market. I mean, we have not gotten above the peaks that we had at the beginning of 22. So I'm in agreement with Mr. Westbury that we're still in the same trend that we were in already. So let's get back to the article. All right, there we go. All right. The driving forces behind the ongoing bear market remain consistent. The accommodative monetary and fiscal policies during the COVID pandemic helped avert a severe recession, but those policies are now receding. The M2 money supply has decreased by 3.6% in the past year. Additionally, the extensive government spending and stimulus measures during the pandemic have worn off, revealing malinvestments and creating economic headwinds. While the economy posted strong growth in the third quarter, it was fueled by unsustainable factors like robust consumer spending and inventory accumulation. Business investment may slow down as companies opt to hoard cash, given limited credit risk. Furthermore, interest rates have risen above inflation levels across the yield curve, eliminating the artificial boost from low rates. The bearish outlook has been maintained since last year, when it was forecasted that the S&P 500 would end 2023 at 3,900. This prediction remained unchanged even during the rally that pushed the S&P 500 up to 4,600 this summer. While it is not an easy stance to take, the perspective considers the underlying factors affecting the market. The natural tendency is towards bullishness, but this bearish view stems from an assessment of current economic and policy landscape. It's not seen as the end of the world, and eventually stock prices are expected to reflect fair value. Moreover, there's optimism about the potential for future technology breakthroughs, especially in the energy sector. It's also believed that the potential pendulum will eventually shift back towards the center, as big government-directed economies often experience cycles of suffering and recovery based on policy changes. Yep, so basically Mr. Westbury's saying that we're going to have to go through that same river of crap that I've been talking about for a while now. And we can delay it. The Fed could print more money and lower interest rates, but we're still going to have to go through that same evolution eventually. You can only push it off and push it off and push it off. And eventually you got to pay the fiddler at the end of the night after he's been right next to your table. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I will talk to you next time. Adios.